We are recording this now. We've gone live. We are recording this webinar. The webinar is entitled Understanding Market Corrections. And I am now sharing my desktop. My name again is Weldon Reeves. I'm the founder and CEO of the investment advisory firm W.J. Reeves Financial Group. And today we're here to provide some context to market downturns, as well as hopefully provide some good financial education about the history of market corrections. And as we all know, markets correct. Markets go up and markets go down. So our goal today with this presentation is to provide some easy to understand financial education that is designed to help all of us make smarter decisions with our money and keep us calm when times seem scary. So thank you for being here, and I look forward to sharing these next 45 minutes or so with you. As always, the attorneys like us to have the disclaimer. So the common disclaimer here is that this is the information in this presentation is for general information only. It's not intended to offer or sell anything with respect to purchasing or selling any securities. And anything that involves the market, any investing activities involves a risk. So obviously there's no guarantees of gains and no guarantees against losses. So the topic today is understanding market corrections, and everybody likes to have their definition of what a market correction is. So what is a market correction? Technically, a market correction is if the market goes down between 10 and 19%. A pullback is between 5 and 9%. If the market goes down 1 or 2% in a day, you'll see the financial press all over it and say, you know, the market pulled back. Well, it was a decline for the day. Bear markets are when we see declines in the market of 20% or more. So now the obvious question is, how often does this happen? So let's take a look. So looking at history and putting all this into context, market corrections are surprisingly normal. So if we look back in history from 1900 to 2016, we've had 125 market corrections. So that's one correction per year about. And we've had 32 bear markets with a drop of 20% or more. So that's one every 3 or 4 years. Lately, it's been more in the range of 7 to 9 years. So you can see the red sections in each one of this on this graph here. The red sections where the markets have gone down and been bear markets. Those are all bear markets where you see the red. So as we all know, they're not fun. Nobody enjoys them, but they do come to an end. The last one we experienced was from 2007 to March of 2009, and I'm sure you all remember that, but as we all know, following March of 2009, there's been a huge recovery. So how do these happen? What triggers a market correction? And as you know, I share office space with attorneys, and so the attorney answer is it depends. Why does the market go down? It can be one of several things. It could be profit selling. It could be missed corporate earnings, or a series of them, obviously. It could be technical analysis, which really means this is where people start to think that the market looks expensive, so they start unloading, and this would be a large group of people that start unloading, as well as the professional money managers. And then fear of whatever you want to say, fear of many things can lead to a market correction. as well as black swan events like 9/11 that come out of nowhere. Now, some people would be asking right now, well, what about economic factors like interest rates and unemployment? I would say that those factors enter into the market movements, but don't always enter into market corrections. Market corrections are bigger downside movements in the market. So what does all this mean to me and to my investments? The answer really is it depends on you and how you react. So first of all, we need to keep in mind that market corrections are normal. So we need to understand this before we even get into the market and invest in the market. Markets will correct. They happen from time to time, and we've just gone over that. So our first reaction, or our first recommendation then, is to recommend that we all stay calm. We keep in mind what our plan is. We don't panic, and we remember the old saying, buy low, sell high, as opposed to buy high and sell low, which is what I call panic selling. If we've created the plan correctly and we've invested according to the plan, then there's no reason to panic sell, because we know that these market gyrations, pullbacks, bear markets, and corrections are going to happen. So in Warren Buffett's words, long term is years, not days. In fact, he says his own mantra is, if I won't own it for 10 years, I'm not going to own it for 10 days. And always keep in mind then that these market corrections do pass and will pass. So let's take a look at this bull market that's been occurring since March of 2009. So as we know, that bear market, 2007 to 2009, was quite grueling. It seemed long, and it was longer than the historical average. But we pulled out of it quite quickly. An investor that invested at the bottom in 2009 with $100,000 would have seen their money grow to over $300,000 through this run. So the lessons to learn here are first, that in the long term, stock markets work, and this has been very good news for those that really struggled through that time period of the market correction, or the bear market that we experienced. However, this market is a market that in some respects many people have hated, which doesn't make sense to me, but they've hated it because they've worried the whole time. Based on that market correction, or that bear market that we had at the end of the last decade, they keep saying, when's the next shoe going to drop? When's the next market correction? And so maybe you're worried too. There's skepticism. So when is the next one? If you worry, you're normal. We all worry. Let me get the next slide to go. Looks like we're frozen here. There we go. All right. So if you're worried, you're normal. Here's a chart that's actually called the investor psychology cycle. And if you start on the far left-hand side, when the market's going up, we have optimism, excitement, thrill, euphoria. And then at the top of that peak there, you see, wow, am I smart? And then the market starts going down, and you see desperation, panic, capitulation, despondency, and depression. Hopefully none of us are experiencing those. And then we say to ourselves, how could I have been so wrong? And then the market goes up again. You start getting this hope, relief, and optimism. And then you have some normal gyrations in the market that start causing us worry. And we need to always tell ourselves this is a temporary setback. I'm a long-term investor. But when it starts coming down again, we start experiencing that fear. So again, how often do they happen and what happens afterwards? Investor psychology actually has a lot to do with market movements up and down. But remember, when bear markets happen, they recover. So this is a great chart. This was from the Wall Street Journal and just shows since 1940 the pullbacks in the market, market corrections, and bear markets, and how fast they recover from each one and the periods of time there. So they don't last forever. The bear will ultimately retreat and go back into his cave. So just for emphasis or repetition's sake, this is an interesting chart that shows us the peak of each market since the 1950s, then shows us the trough when it has gone down. So if you go down here to the bottom, the peak prior to the last serious bear market that we had was October 9th, 2007, and then it bottomed out March 6th of 2009. That was a duration of 17 months, which was longer than a lot of them that we've had. It was a decline in the Standard & Poor's 500 of 57%, and 12 months later, the S&P 500 was up 77%. The one that you probably remember very well was also the tech bubble that burst in March of 2000. That one actually lasted the longest in history, or at least since the 1950s. That lasted 31 months from peak to trough. It went down 49%. But 12 months later, the S&P 500 was up 34%. So the averages here, the median here, is that a bear market lasts about 10 months, goes down about 27%, and a year later will be up about 35%. That's, again, just historically speaking. So you say, okay, great, but I still want to move into cash, or I can't wait this out, I'm nervous, and I will buy back when the markets go up. What I find, however, is that the nerves and the fear that caused the selling in the first place still exist when the market begins its recovery and starts going up, and doesn't allow your psychology doesn't allow you to get back in until you've missed out on a lot of the upside. So this is a great chart from Behavior Gap that tells the story we always share with our clients. Don't buy high and sell low. Our philosophy here at our firm is that you buy, manage, and hold, because the markets work over time. Timing doesn't work. Warren Buffett and all the other experts out there will tell you that it doesn't work. I've been teaching this and doing this for real life clients now for over 20 years, and it doesn't work. People who panicked in 2009 and sold completely missed the upturn, like I said previously, because they were too nervous to get back in. So don't let this be you. If you're trying to time the market, you've got to be right on both directions. So let's put this in context now and look at this next chart. It's quite fascinating. From 1980 through 2015, the S&P 500 returns 12.5%. So that's awesome return over that long period of time. So what if an investor missed out on the 20 of the best days of that particular market? If you missed the 20 best days during that period from 1980 through 2015, the investor would have earned only 7.2%. So would have lost over 5% from the 12.5% that could have been achieved. So if you sit out the market and you miss, let's say, the best 40 days of the market during that period of time, your return would have been only 3.7%. And if you missed the 50 biggest days, your return would have only been 2.2%. The point here is that you could simply be really unlucky and get out of the market right before it heads back up and miss the bulk of the market returns. So our approach and what we're finding in our research is the best approach is to invest long-term and try not to time the market. I always like to say it's time in the market that matters, not timing the market. And actually, David Bach has that in his book. Rich Couples Finish First, I think is the name of his book. So history's on our side. If we stay in the market over the long run, we're going to reap the benefits that the market has to give us. Over time, historically, the markets have gone higher. And obviously, we can't promise that history will repeat itself, but it's how we learn. And if we learn from history, history tells us the markets go up and down, but over the long run, they trend upwards. Another thing that we show in our data with our clients as we're reviewing portfolios is that over time, the portfolio actually experiences less volatility. So in a year's period of time, a portfolio might swing from a negative 20% up to a positive 40% or anywhere in there. But as you hang on to that investment portfolio and manage it appropriately, those swings or that volatility in your expected return will become more certain and less volatile. So this is an interesting chart here. This is to show, again, years in the market that go up right here. The up years from 1937 through 2016, 61 of those years, or 76%, were up years. Oops, moved that too soon, sorry. And of that period of time, there were only 19 down years, or 24%. So some of you may be saying, okay, that's great. I'm still nervous. The market's been on a rise for a long period of time. And I just read that investment X is now where I should put my money. So what do you think about switching investments? So let's look at one of my favorite charts. And if that doesn't make your eyes go crazy on your computer screen, I don't know what is. But we call this the investment Skittle chart because it looks like a bunch of Skittle candies. But this shows all types of investments. It shows mid-cap value, real estate, small-cap value, large-cap value, mid-cap growth, high-yield bonds, large-cap growth, small-cap growth, intermediate-term bonds, foreign stocks, short-term bonds, even commodities. Now let's just look at this and say, well, I like gray. So let's invest in gray, which would be your commodities. And so in 1997, commodities were probably your worst choice. And gray again, the next year, 1998, again, bad choice, lost 27%. But then let's see, in 1999, it went up commodities went up quite a bit. 2000 up and then down again, and it just on and on. It's just all over the board. And so what you can say here, let's go back to 2000 when commodities were the best, and you could say, well, the end of 2000, commodities looked awesome. So starting January 1, 2001, I'm going to put all my money in commodities. And then in 2001, at the end of 2001, we see that, well, commodities lost 19.5%. So it's just all over the board, and I'll just keep clicking this to get, as you see, 2011 through 15 have not been good for commodities at all. So what I learned from this chart is that from year to year, we can't pick the winners. What works better is picking a diversified portfolio, which is the black. And you see that black stays in the middle pretty much throughout the whole chart. And if you review at the bottom of the chart, you see the 20-year annualized return for a diversified portfolio is 7.5%, which is an excellent average return for managing risk of the portfolio and without driving yourself crazy trying to time the market or time the specific investment choice or sector that you get into. So what do we do during market corrections? Let me get there. Let's let the slides catch up. 5 things to do during a market correction. Number 1 is be patient. Don't overthink it. Fight your instincts, which is usually flight. Fight your instincts, stay diversified, and make sure you're working with us or a financial advisor to just make sure your plan and your assets are where they should be. Reassess your situation. So what I like to say is, don't worry, let's talk, call us, that's what we're here for, and actually that's the exact reason that you hired us. So again, because this process of financial planning is about your goals and your dreams, we've got to make sure we're talking even through market corrections and bear markets. So if you have worries that you're off track because of any recent events, let's talk, let's take a look, let's review your situation. Let's talk about anything that's keeping you up at night. And let's look and see if there's anything new that you should be doing. It's possible that there's some great opportunities. So let's talk, let's reduce risk. There may be opportunities to reduce risk, but that's why we're here. Give us a call. We've seen these markets before. We'll see them again, and together we can get through them. One of the reasons why I wanted to cover this information now is because many people are talking about a future market correction. And again, if we look historically, we can say there's probably a correction on the horizon. But I wanted to make sure that we're all educated so that we don't go into this up and down emotional cycle and do things like shoot ourselves in the foot at the bottom of the market and try to do what I call panic selling. So I hope this has been helpful for you. Let me see if I have the technology skills to unmute and allow you to ask any questions at this point. Let me find that button here. Unmute. If you have questions, let me know and I'll see if I can answer them. If not, I can find answers and get back with you. And we'll wait a few seconds here, and if nobody has questions, then we'll just sign off.
Thank you, Will. And this is Jerry.
Hey, Jerry.
Just hang in there.
Good. And stay off ladders.
Yeah, for sure.
All right. Anybody else?
Thank you, Weldon, for doing this.
You're welcome. Hope it's been helpful. Again, we'll sign off now. If you have questions as follow-up, send me an email, give me a call. I'll be happy to help. You guys have a great day and enjoy lunch. Talk to you later.
Okay. Thank you very much.